Okay, from a timeline perspective, we're going to move on to post the organizational meeting. And we have a new set of panelists, so I'll just ask everyone to kind of go down the line, introduce yourselves, as talk about the role you play within the IPO process.
Super. Hi, everybody. I'm Gregg. I'm a partner at Goodwin Proctor. I work with technology and life sciences companies sort of throughout their life cycle. The role I play, yeah, we're the lawyers. I've done a number of IPOs in my roughly 18 years of practice, and I've worked with a bunch of folks on this panel a number of times.
I'm Zach Canter. I'm a managing director in the software investment banking group at JP Morgan, based in Boston. I've been covering the software space for the last 10 plus years. I've been at JP Morgan for the last 6.5 years. And within the software space, I spend most of my time with enterprise application software companies, with a particular focus on human capital management, but really my focus is sort of across the world of software. And within the IPO process, I like to think that we are the quarterbacks of the process of drafting, but I feel like I think it's a shared responsibility amongst all of the advisors as well as the leadership of the company. But we do a lot of hand-holding with management. We do a lot of work drafting the business section of the prospectus, a lot of work with creating and updating the materials which are used as part of the analyst day presentation and the roadshow deck, coaching the management team on the marketing strategy and what the story is that we're going to tell to investors, and all of sort of the investor-facing marketing of the IPO.
Hi, good morning. My name is Jolley. I'm with Workiva. We are a software company that helps the entire process for a successful IPO and submission to the SEC. We have technology as well as service to make sure we support the various quarterbacks that are engaged in this process, and we work again all the way through the journey with the organizations.
Good morning, everyone, and welcome. So my name is Arto Suren. I'm a partner at KPMG Valuation Services. When I say valuations, it's about incentive units, business valuations, intangible valuations, any type of valuations. But in the context of an IPO, the main support we provide is 409A valuations. I'm sure most of you are familiar with 409As, but in essence, a 409A valuation is a valuation of a privately held company's common share, and that's used to issue stock options for your management as incentive. So that's where we come in as part of the IPO process. As companies get closer to an IPO, the cadence of a 409A valuation increases, and we usually do either every 6 months or every quarter valuations so that the company can issue safely without tax consequences incentive units to their employees or management.
Yeah. Hi again, everyone. Gregg Stamm, audit partner here in Boston, serving life sciences and technology clients. Been with the firm for about 20 years now. And our role really in this process, especially from this panel, is not just getting through that S1, but also helping our clients be ready for the cadence of being a public company. So thinking about your timing of your Ks and Qs going forward and getting ready for that fun day that hopefully will come when your market cap's big enough that we need to step in and be issuing a SOX opinion on you as well.
Perfect. Thank you all. So we alluded a little bit before about the due diligence process, and maybe I'll turn this over to Gregg, but what are companies doing to kind of prepare for the due diligence process, and who is doing the due diligence process? What is the role of due diligence in an IPO?
Sure. So the last panel covered it a little bit, and I put this in the category of be prepared when you enter the org meeting, right? One of those things is we like for our companies to be able to, at the org meeting, tell the working group, okay, once you leave today, everybody's going to be getting an email, and you'll all have access to the data room that is fully populated and organized, and you can get going on your diligence. So what is the purpose of the diligence? So the technical legal purpose of the diligence from the bank's perspective is to be able to build their due diligence defense. When you talk about liability for sort of material misstatements or omission in a registration statement, the underwriters have a defense to a lawsuit to say, well, hey, we did our due diligence on the company. We reviewed all their records, all their corporate records, looked at litigation, looked at their products or technologies. We did the work that we needed to do to protect the investors. The company does not have that. The company has strict liability. So if there's a material misstatement or omission, there's liability. But that's the technical basis for it. But also it serves the function of making sure everybody in the working group, the bankers, the lawyers, really understand the business and what's underlying the business. And part of the diligence is not just documentary, it's the drafting sessions, it's the org meeting, it's learning about the company, because you have 200, 300 pages worth of disclosure, everybody's contributing, and to be able to do that on a really informed basis is going to help drive efficiencies in the process. And then just thinking about, well, how do you set it up? Have a conversation early in the process with your outside lawyers who've seen this a lot before, and they can give you a structure on what to put in there and how to organize it. Putting together that data room also helps the company find holes maybe in some of their corporate records and say, oh, well, we're missing board minutes between X and Y. Let's go figure out, where those are, so that when the data room is open to the full working group, the company feels confident that what they're presenting to the group is, done in full and is in really good shape, so that everybody feels good about moving through the process.
Perfect. Thank you. We're going to stay with you for another question, but once you've confidentially submitted the S1 or you're on file with the SEC, what happens next?
Sure. So typically there's a couple of things. One, from the legal team's perspective, that's usually a good time to start working on all of the governance policies and procedures that the company is going to need to adopt for its life, operating as a public company. The other thing that we often see, and Zach, maybe you'd speak to this a little bit, is starting to think about testing the waters meetings and pulling together that testing the waters deck, because, in today's IPO environment, there's even a greater emphasis on earlier contact with potential investors, getting them to know the story, rather than maybe one or even zero rounds of those meetings and just going to them at the time of the roadshow.
Yeah, I think it's a great point. I think one of the biggest critiques that public market investors might have had about the bonanza in 2021 was it was speed dating, right? They had no time to get to know these businesses and do the kind of diligence that they want to do before making an investment. And I think, fast forward to where we are today and what the future IPO landscape may look like, I think it'll probably look more like, the pre-COVID, 10 to 12 software IPOs per year kind of environment. I think the best thing that companies can do is do a lot of testing the waters and build a rapport with the public market investors that you're going to look to have participate in your IPO down the road, so that they've been able to meet you over years and really see how the business matures, how the story matures, and they can get real conviction on the business, and that's what will lead to them wanting to own a big chunk of your company in an IPO.
Your mic
Great. So
in and out. Half of us can't hear.
Okay, I'll okay.
Better.
Okay, it might be that specific mic, but we'll share. Okay, so now you've been working kind of along the way, and you get an SEC comment letter. So you have your first response from the SEC after that first confidential filing or a subsequent filing. What happens now? What do those look like? What are we seeing in SEC comment letters?
Sure. So the SEC typically takes about 30 days to send you their first comment letter after they review the S1. We are seeing, I think Bill mentioned it on the last panel, we are seeing longer processes working with the SEC. I mean, you all may have seen in the last couple of years, the SEC has been putting out a lot more sort of rules and regulations than they had in prior years, and they're just more focused on I think on their review. And so what the company need to do is be ready that when we get the comment letter, we're trying to keep to a timeline, so get the working group ready to divide and conquer, right? Some of the comments are based on the business section, some are risk factors, some are financial based. so that you can put together your responses and get back to the SEC promptly with answers in a revised draft. And it will vary from deal to deal how many rounds of SEC comments you're going to get. I would expect, typically at least 3, and it can be a lot more in certain circumstances.
Gregg, Stamm, maybe you can talk a little bit about trends that we're seeing in SEC comment letters from a financial perspective.
Yeah, sure, Jen. I don't have to be this. So I think especially for a lot of people in this room, we've got some of the examples up here that are perennial hot button items, but if you think of things like revenue recognition, a lot of questions on how you determine your performance obligations, and that goes not just on the technology side, but also life sciences in your collaboration arrangements. Also, how do you determine standalone selling price for allocating between performance obligations? So those are things that really, anywhere where there's judgment, you want to look at your footnotes and say, am I disclosing enough that I feel comfortable with my level of disclosure, but also that I'm kind of answering the questions that I might get to hopefully avoid that comment. Also, some things like debt and equity, a lot of things we focus on in the first year audit, convertible and redeemable equity. How did you determine that was equity versus liability classification? Any impacts of things that could have been dilutive to EPS that aren't being included in there? Is there enough discussion in the document that the SEC can understand that, or are they going to have to ask that follow-up of why didn't you include this in your diluted EPS? Probably a big one for a lot of the companies going public is that segment reporting. For AICPA companies, usually you're not issuing a segment footnote, so that's a first-time exercise for a lot of people. And the SEC may have a lot of comments there about how you determine your segments. And throughout all these things, a lot of it is look at your financial statements in the front half of the document, and does your story line up? Often some of the questions we'll get in the financial statements is, well, in the MD&A or elsewhere in the business case, you discussed your revenue stream like this, but here's how you discuss it in the footnote. Help us understand and align those things. So I think a lot of prep goes a long way. Benchmarking yourself against other peer companies and looking at their 10Ks or S1s, as well as just looking at what are the hot button items out there and really thinking through those decisions you've made and the adequacy of your disclosures. Also, shameless plug, I think on October 25th, KPMG is doing a annual update on the items we're seeing from the SEC across the national practice. So you can be on the lookout for that webinar.
Perfect, thanks. Along the same lines, Arto, maybe from a valuation perspective, could you discuss a little bit about what it means to have a cheap stock issue and also maybe what we're seeing for trends and valuations in the current environment?
Yeah, no, that's a great question. The cheap stock issue is really when companies, before they go to IPO, privately held companies, you issue common stock options for the employees. And in order to benefit from a deferred compensation rules for tax purposes, that incentive unit, that common stock option has to have a 0 intrinsic value at the time of issuance. The idea is that you issue a deferred compensation, the incentive unit at the time of the issuance is worth 0 from an intrinsic perspective that date, but it's going to share the upside when the company goes obviously to the IPO. And by doing that, the recipient who receives the options, they don't have to pay taxes at the time of the receipt, but they pay later on their taxes when they exercise, which is the whole idea. That's a deferred compensation. The 409A valuation, the main purpose is to give you that strike price, which is equal to the fair value of the common share, which becomes the strike price of the options that you issue under that deferred compensation. So that strike price obviously changes as the company gets closer to the IPO. The value, again, for the common share theoretically is increasing. So that's why companies have quarterly or every 6 months an update on the valuations to revise the strike price of the options. So that's really the purpose of the 409A valuation, to prevent 409A issues. From a trend perspective, not to state the obvious, but it's a challenging environment to raise money for a private company. So we are seeing quite a bit of a shift in the way the capital is raised, right? The typical way of bringing VCs or PEs and raising, let's say, 50 million Series C or Series D round is rare these days. So we see companies doing more structured in terms of tranched investments. So instead of the PE or the VC coming in, the investor coming in and putting the 50 million at once, we see that part of it goes at day one, let's say 20 million, and the rest, especially for life sciences companies, are tied to specific milestones. And the investors will say, okay, we are going to release the tranche 1, tranche 2, tranche 3. If you hit those specific milestones just to incentivize or maybe protect their investment. So I've been doing this for 16 plus years, and I've never seen this many tranched structures for preferred rounds that we've seen in the last 1 year. So it's very popular. The other way that we see companies raise capital, especially for life sciences companies, that we are seeing more and more collaboration agreements or research agreements signed with big pharma. That's an alternative to raising money. You are basically out licensing part of your IP in exchange of cash today and then some milestone payments in the future. So that's been also extremely popular with life sciences companies. That creates obviously valuation needs and accounting needs, but that's again another shift in the capital raise in the recent years.
Gregg, stepping away from the registration statement and the prospectus, are there other documents that are involved in the IPO process?
Sure, there's a variety of documents involved in the IPO process. I alluded to some of them a few minutes ago when I talked about all the policies and procedures that a company would need as a public company. But in the process itself, and there's an underwriting agreement, right? The agreement between the company and the banks, pursuant to which the company sells shares to the banks, and then the banks, take those shares and sell them to the investors. And so it's a fairly standard form of agreement that's negotiated between counsel between the of the company and the banks, but that is usually not sort of a big hump to get over. Another important document in the process is the lockup agreements, and Bill alluded to them in the last panel when he talked about pre-IPO investors being restricted from selling post-IPO for a period that historically has been 6 months. I would say in the last couple of years, certainly during the sort of boom in 2021, there was a trend toward more creativity in lockup releases, sort of tiered lockup releases, sometimes around earnings releases, sometimes around hitting certain price thresholds. I think that it probably remains to be seen exactly how lockup trends are going to play out when the IPO market comes back in full. But I think that folks, in the industry, acknowledge that there is a little bit more flexibility to try to figure out how best for the company and its shareholders and the market to see those shares being released, post IPO.
Thank you. Zach, maybe you could talk a little bit about the roadshow process and what we're seeing in the current environment, a little bit about the timeline and what companies should expect as part of that process.
Yeah, sure, I'm happy to. So if you think about sort of the timeline post filing the prospectus initially with the SEC, you basically pivot immediately to drafting the analyst day presentation, which is it's a long set of marketing materials where you spend several hours telling the entire story to the research analysts who are going to be covering the company. You then take, and that's a heavy lift. That's a lot of content creation. You take that very large set of materials and you slim that down to a 15 to 20 page deck, which you use as the basis for your testing the waters materials, and then ultimately your roadshow deck. And so I think when we go out and talk to investors as part of the actual roadshow, during the time of COVID, we made this major pivot going from an actual physical roadshow where you were getting on a private jet, you were flying all over the country, and it was this 2-week slog of sleeping in hotel rooms and eating just crazy food. And I always tell CEOs and CFOs, don't step on a scale while you're on the roadshow. And we made this major pivot during 2021, which was remarkable because I think the prevailing wisdom, and I shared this wisdom, was you have to sit across the table from these investors and they have to see the whites of your eyes and you have to tell the story and they're going to draw their conclusions about whether or not they want to invest. And when COVID hit, we made this major pivot to doing it on Zoom, and lo and behold, it worked out just fine. And so I think what the IPO roadshow is going to look like going forward, I think it's going to be something of a hybrid. There's going to be, some in-person meetings, and there's going to be some Zooms for convenience. And it is a major convenience being able to be in, just like we all experience in our daily lives, being in San Francisco at, 10 a.m. and being in Los Angeles at 2 p.m. and being back in Boston at 4 p.m. Zoom is incredibly efficient for this process. But basically, you meet all the investors and you build the book. And by the end of the roadshow, hopefully we've got a majorly oversubscribed IPO and we can price the thing.
Great. Well, assuming that we do complete the roadshow and we have the book filled out, how is the price determined?
So the price is determined based on, it's supply and demand. It's sitting in a room with all the key decision makers, including the banks, including the management team, including the board of directors or whoever is appointed by the board of directors to, make decisions about the pricing. Basically, you look at the demand and you settle on a price. Now, over the course of the book building process, over the course of the roadshow, the banks are taking indications of interest from the prospective investors. And there's a price on the cover of the IPO of the prospectus, which indicates where we're looking to price the IPO. But it's supply and demand, so we can price the IPO in the range, above the range, sometimes below the range if necessary. And basically, it's building, the best possible book of investors at the best possible price that suits the objectives of the company. And so sometimes there's availability to go higher, but you're going to lose certain investors, and other times, the opposite is true. And it really depends on the company and their pre-existing investors and what's most important to them. And that's what we try and do as banks is achieve their objective. So if their objective is we want every last dollar in the IPO, then that's what we'll try and do. And sometimes that comes at the expense of having the best quality investors, the best mutual fund investors that are going to be long-term shareholders. And so I think what we advocate for is trying to strike a balance between getting the best price and getting the best investors. But ultimately, we're trying to achieve the objectives of the management team and the board.
Great. Maybe we'll turn it back to Gregg Stamm. From a financial reporting timeline perspective, now that, hopefully you've priced and done really well, and now you find yourself as a public company. So what do you have to think about from a financial reporting timeline perspective?
First, why'd we do this? Can you advance the slides?
Yep, I am.
Yeah, so we talked all about that preparedness in the last panel about, making sure you've got your team and your processes in place. And now it comes down to you're public, and how do we do this on a normal cadence? So up here, the bottom table, you can see, the timelines for filing your quarterly financial statements on Form 10Q, depending on your status, be that non-accelerated, accelerated, or large accelerated. That's going to range from 40 to 45 days after your quarterly period end. And then similarly for your annual financial statements on that 10K, that's going to range from 60 to 90 days. So gone are, the fun days of just being able to get maybe a bank waiver or a VC investor waiver for a little bit of an extension there. And then up above, it has some of the details, and I'll say the Rubik's Cube of determining your filer status. And that's a two-part test based on whether or not you've got revenue above or below $100 million. Is going to depend on whether or not you're in that top table or the middle one. And then it comes down to your public float, which is measured at the end of your second quarter annually. And the 100 million in revenue, that's based on your latest 10K. So most, predominantly all recent IPOs will find themselves as non-accelerated filers in that first year of meeting their filing requirements.
Great. So maybe we'll ask JP Morgan and Goodwin from their perspective, when you're working with companies that go through the IPO process and find themselves as new public companies, what are some of the challenges that they're facing in the early days of being a public company and having to adhere to some of these deadlines and new scenarios that they haven't found themselves in before?
Sure. So a couple of thoughts from my perspective. First, do everything that you can to hit your first quarter out, right? I mean, missing on your first quarter is not a great way to start your life as a public company, and it does not engender a lot of excitement among your new investor base. So plan accordingly. From a team perspective, the IPO process obviously takes a lot of effort, particularly from a finance team perspective. And sometimes the team is built out in advance. Sometimes it's supplemented with consultants. But don't forget that once you flip into life as a public company, you're still going to have a lot of finance needs. You're going to be needing to, close your quarters on a specified basis. And so if you don't have the team in place yet, plan accordingly for any outside, consulting support that you'll need.
Yeah, I would add that I tell every CFO when we're going through an IPO process, think of the first 4 quarters that you're forecasting, that we're telegraphing to the research community. If you miss any of those quarters, it's a fireable offense. That's how you should take it as a CFO. Now, is it necessarily a fireable offense? No, it's not necessarily a fireable offense, but that's, I think, the right approach you want to take, because the stock price reaction can be really unforgiving if you miss one of those early quarters out of the gate. And the other thing that I would say is, automating all of the small tasks that you do as part of your, financial close process and just the way that you budget and forecast and run your financial operations is so important, because once the bullets are flying in your public company, things sort of just need to work. And so I think that that's really important.
That's a great segue. So John, maybe I'll turn it over to you. From your perspective, how can technology kind of support the process of the registration statement? What are you seeing as actually occurring with the companies you're supporting?
Yeah, look, I think we can quickly identify there is no easy button when you decide to go through the IPO process. You have multiple stakeholders in the journey. You have to time the timeline based off of comment letters, market conditions, and you have a lot of people that are dividing and conquering to have a successful registration statement. What we're seeing more and more is technology can be used to collaborate with the entire working group to really have a better control of the document and ultimately a better control of the timeline. And by using technology, we're seeing an easier process for the entire working group with a better experience at the end of the day.
So if you are thinking about incorporating technology into the process, what would be the ideal time to engage a technology vendor and support team?
Yeah, I think a lot of times companies will look at technology as a filing agent. And if you look at it through just a filing agent, usually it's about 30 to 45 days prior to your first confidential submission is where sometimes we're being pulled into those types of discussion. What I'm finding more and more best practices, and you heard it in the earlier panel and here as well, and being prepared, is companies are really starting to leverage technology for their whole uplifted reporting process. You think about, you spend time with accounting and advisory services, you're building narrative around those disclosures, right? They're not just Excel tables anymore. You have to put narrative to them. You're building out that first draft of maybe the MD&A. And how are you collaborating with some of the advisors and different stakeholders to build that up? And that's really where I see technology swimming further upstream in the preparation aspect and not just looking at it from a direct filing agent to that 30 to 45 days prior.
Perfect. And even as companies are public, from a K and Q perspective, what are some best practices you're seeing for how companies can prepare and execute around those quarterly or annual filings?
Yeah, leverage that S1. You spend all that time and energy and telling the street and the world of who you are as an organization, going through the compliance aspect of it, making sure that you're positioned in every aspect. Leverage that S1. A lot of times what we tell our organizations is, don't worry starting to build out a 10Q, 10K. 2022 could hit where you had a whole story and a whole narrative of what your business model was going to look like. And then market stalls, and then you're back to the drafting table to work on the S1 to accommodate. And then now you're trying to redraft that first 10Q, 10K prospect. What we really see as best practices, wait until you do your first public flip. That first public flip really will become the backbone of maybe your first 10Q and 10K.
Great, thank you. So we're going to change topics a little bit away from financials and talk about board composition. Gregg, maybe you could give us some insight on what companies should start thinking about of what they want from a board composition perspective.
Sure, and this is something to be thinking about, as you're leading into your IPO process. There are specific rules, I think Bill mentioned it on the last panel a little bit, about independence on your board overall. There's also rules about independence on your committees. Typically when companies go public, they'll have an audit committee, a compensation committee and a nominating and governance committee. You'll need a sort of quote super independent audit committee chair, and there's certain rules about that. And there's also specific independence rules about your compensation committee as well. In addition, you need to be thinking about the composition of your board from a skill set perspective and from a diversity perspective. Not only is it critically important to have diversity on your board just to have good governance and good direction, but there are also new rules that have come out over the last few years about the number and sort of percentage of diverse members of your board. So in order to find great qualified independent board members to fill those seats, that often takes time. Sometimes those folks can be found through people's networks, but oftentimes there are search firms involved as well. So you can't assume that, oh, we'll just go get a couple of new independent board members, it'll take a few weeks. No, it typically takes months to be able to find the right people to fill out your board.
Great, thank you. Not to scare everybody once they're a public company, but there's also the term of SOX. So Gregg, from your perspective, when should companies that are newly public start thinking about internal control requirements and building out teams around that?
Well, I think really probably before they become public. I mean, that's something as you're thinking about your IPO readiness, starting to think about, what are your controls and do you have the bandwidth to document your process, identify your key controls, and probably maybe some assistance implementing some controls where there might not be some. And then it's also your internal auditors, who's going to do that test work to assist in management's first report. So for the first 10K you file, you get a buy. There's no SOX 404 compliance from management or external auditors in that report, but that second 10K will have at a minimum a management certification on your controls. So you'll need the test work and diligence to support that. And then depending on whether or not you're an accelerated filer or large accelerated filer, you would need a attestation by your auditors on your controls, with the exception of if you retain that EGC status. That's the one out if you're accelerated filer, that you will not need it until you drop that status, as we discussed earlier. So really, if you're first thinking about it after the IPO, it comes quick. If you think about right now, if you went public this quarter, file a 10K in February or March, you already need to be SOX compliant in 2024 and be ready for that certification in your FY24 10K that you'll be issuing in February or March.
Great, thanks. I think we've had a lot of great insight from the panel. Maybe Gregg and Zach, I'll just ask you as closing, what are some of the critical mistakes that people want to avoid when going through the IPO process?
Well, I think we talked a lot about the critical mistakes to avoid right after your IPO. Listen, it's super important to get qualified advisors, and we're all obviously biased here. But it is a long process. It is a critical milestone for your company and for your investors, and it is a path that qualified advisors understand. A lot of my companies go and say, "Oh, we're going to do it faster. We're going to do it, differently. We're going to, breeze through the SEC because everything is all set on our side." And it's great to have that idea, but honestly, like there is a pattern to these. There is a process. There is a cadence, and having advisors, whether it's bankers, auditors, lawyers, technology providers, or otherwise, that really know what they're doing, have seen it all before, is super important to help you avoid mistakes.
Yeah, and I would just sort of add to that, not only qualified advisors, which we are, but advisors that you trust, right? When you're unable to really go open kimono with your advisors, you can get the process done, but I think it doesn't get done as smoothly. Sometimes you just don't get the best experience. So you really want to find advisors that you trust, and there's mutual trust, and you guys have an open dialogue, and you're able to share real, content and color and information about, what's going on with the business and how best to position it. I would also say the ability to forecast. When I look at companies that struggle, or companies that miss out of the gate, or companies that just don't trade well or don't perform well, it's usually not because they don't have a great leadership team. It's not because they don't have great products. It's because they have a really hard time forecasting, and that's what ends up with misses and restatements and everything, all this bad stuff. And so I think having your finger on the pulse of your sales force and how they're performing and how to forecast what they're doing accurately is extremely important.
Great. Well, thank you guys so much for your participation. We're going to take a quick break before our next panel of experienced IPO survivors. So we will come back in 15 minutes, James?
Yeah, 15 minutes.
Okay, perfect. Thank you all.